Most people assume wealthy retirees have some secret list of assets that they load up on. But in reality, the difference between rich retirees and poor ones, it usually comes down to avoiding the bad assets. So today, I'm going to walk you through the 7 assets rich retirees almost never buy and why avoiding these can save you hundreds of thousands of dollars over your retirement. Now keep in mind that these aren't fringe products. These are not esoteric assets that are very difficult to find. These are everyday assets that I see good intentioned people buying. They're trying to do the right thing, but they end up locking themselves into products with high fees, poor performance, and illiquid investments. Okay, let's begin. Number 1. Actively managed funds. These are funds where a manager tries to beat the market through stock picking or tactical trading. This is called active management. So think American funds, the Fidelity Contra Fund, T. Rowe Price there, Blue Chip Growth Fund, JP Morgan Large Cap Growth. This can also be yourself actively managing your own account. The data on this subject is extremely clear. It is difficult for active investors to outperform the benchmarks over time. So if you're trading stocks in an attempt to outperform the S&P 500, know that doing so consistently over time is very rare. It's so rare that even those that have been proven to do so, think Warren Buffett or Jim Simons, they're very famous and incredibly wealthy. So if you believe that you can consistently beat the benchmarks, then you are either 1, in the wrong business. You should be working on Wall Street, managing your own hedge fund. You'd be making far more money than you are right now. Number 2, you're ignoring or just unaware of the ample amount of evidence telling you that the markets are quite efficient, especially here in the United States. So finding and exploiting an edge that nobody has discovered, that's quite reckless. And just know that there are armies of analysts and investment professionals out there whose sole job is to look for inefficiencies and misprice assets. Or number 3, you're just wrong. So it is quite common for investors to confuse luck with skill. And if an active investor is having a very good year picking stocks, then of course, it's due to their ample skill. However, if they're having a very poor year with their investment portfolio, then it's due to bad luck. So the truth is, most markets are very efficient and they're going to likely continue to be efficient and move in that direction. As technology advances and as data proliferates, most investors are just better off owning index funds. Okay, number 2, structured products. These are complex, Wall Street engineered products that promise downside protection with some upside participation. So examples of these are market-linked CDs, buffered ETFs, equity-linked notes, principal protected notes, and so on. So the pitch for these products is something like this. If you think that the market's going to go down and you want some downside protection, you can buy a structured product that's going to guarantee that that downside is limited. Something like a 5% decline or 10% decline, or even a 0% decline. But the cost of that is that you're going to have to cap the upside. 7%, 10%, something like that. So each product is different, and the underlying mechanics of these things are pretty complex, and they usually involve options or futures contracts. These products are also very expensive to own. So these products, they're built to look safe. They're anything but. Outside of the nominal cost you pay for these are the biggest risks of owning them. 1, you give up most of the upside. This to me is the biggest cost because the upside is limited. So whenever the market rallies, you're going to miss out on so much of that upside, and the opportunity cost of not participating in that is just so great. Number 2, you're going to be taking on a lot of issuer credit risk. So what does that mean? If Merrill Lynch created these products are only going to be as good as the credit of Merrill Lynch itself. So if they go under, so does this investment. Number 3, these things are not liquid at all. So if you want to sell out of these early, good luck. Number 4, these are overly complicated, and you may be taking on a type of risk that you don't even fully comprehend or realize. So in short, I really don't see a good reason why anyone would own these type of products, and I've never recommended them to anyone. So stay away from these. Okay, third on our list is timeshares. Of course, timeshares are when you own a fractional right to use a property for 1 or 2 weeks per year. So think Marriott Vacation Club, Wyndham, Hilton Grand Vacations. So the reason why you would want to avoid these is that it simply doesn't make any financial sense. Timeshares, in my opinion, is one of the fastest ways to destroy retirement cash flow. So they have high upfront costs. They have a lot of ongoing maintenance fees that's going to increase annually. They have a terrible resale value and it's pretty limited flexibility in terms of their availability. And they are quite difficult to unwind. Most of these don't even have a secondary market that you can even sell to if you wanted to. So the only way that I see this making any sense for anyone is if there's someone who already vacations in one location every single year and they know that they're going to continue to do so for decades, which in my opinion is extremely rare. So if this is not you, then skip the timeshare pitch next time that you're in Hawaii or Mexico. Okay, number 4, ultra high yield stocks. So I'm not talking about normal stocks that pay out a normal dividend like 2, 3, or 4%. I'm talking about stocks or funds that are going to pay out an unusually high dividend like 7 to 12%. So a lot of people, they don't really seem to know this fact, but the reason why companies are paying such a high yield, it's because the underlying business is declining. If a company pays out an annual dividend of say, let's say $3, and its stock price is $100, then that's a 3% yield, right? If that stock price falls to $30 per share, then that $3 dividend turns into a 10% yield. So some examples of this are stocks like UPS or Jack in the Box. They may have a well-known name, but that doesn't necessarily mean that their stock price is going to do very well. Some REITs have really high yields, and closed-end funds that use leverage to boost their yields. These are also examples of what I consider very high-yielding stocks. So I get the appeal why someone would want to buy this. So the idea is to collect the income and wait for the stock price to bounce back, but there are a few major flaws with this strategy. First, there is a reason why this stock price fell in the first place. Is the revenue declining? Is the company poorly managed? Is the industry that it's performing in, is that shrinking? Now the company might never bounce back. I mean, you have no idea whether it will or it won't. Second, that $3 dividend that I spoke of earlier, that might get cut, especially if the company is facing a lot of cash flow problems. If they're overburdened with debt, they may have no choice but to cut or even suspend that dividend entirely. And if they do, now you're stuck with a pretty lousy company that's going to be yielding zero. So this is what is called a dividend trap. Those people who chase yields like this usually end up with capital losses far greater than any income that they might have gotten from dividends in the first place. So do yourself a favor, don't fall for the dividend trap, and know that there are better strategies out there. And quick note, if you find this helpful, be sure to like and subscribe to this channel. It really helps the channel grow so more people can see content like this. Okay, let's continue. Number 5, variable annuities. So variable annuities are insurance wrapped investment accounts with mutual fund sub-accounts and optional riders. Simple, right? So variable annuities, they are often pitched as life insurance and investment portfolios wrapped into one. It sounds appealing, and a lot of these will offer income guarantees like a 6% income guarantee during retirement, regardless of what the market does. A few examples of these is going to be Prudential FlexGuard, the Allianz Accumulation Advantage, Jackson National Perspective, Lincoln Financial Eye for Life, Nationwide New Heights. So here's why you want to avoid this. Variable annuities are highly complex products with really high fees, like 3, 4, even 5% annual fees baked into that product. It could even be higher the more and more riders that you add on to it. The surrender period is usually somewhere between 7 and 10 years, meaning that you cannot get out of this product without paying really hefty penalties. Know that there are very confusing riders on these products as well. Again, riders are just add-on features that you can add on to your annuity, like a long-term care policy or a guaranteed income rider. Insurance salespeople, they like to tout the fact that these accounts, they can grow tax-free, which is true, but what they never really reveal is that whenever you turn on the income and they take from these gains, they're not taxed at a lower capital gains tax rate. They're going to be taxed as ordinary income, which is probably the worst tax scenario you could be in. So this one for me, this is one of the worst assets a retiree can have. Now, of course, there are a few exceptions where a variable annuity can make a lot of sense, but it's going to have to be a no load, a low fee option, and the client's personal circumstances are going to have to dictate a product like this. To me, this is extremely rare, so I would be very wary if you're being pitched a variable annuity and know that it might not be in your best interest. Okay, number 6, whole life insurance. Another insurance product that I'm not a fan of is whole life insurance. So this is a permanent life insurance. It's going to be packaged as an investment, and the term whole life insurance, it includes other products by the name of universal life, index universal life, and variable universal life. So why should you avoid this asset? Simply put, life insurance is not an asset class, even though insurance salespeople they pitch it as one. The biggest issues that I have with whole life is that it typically has really low returns. 4% is its long term average return, and the fees are very high, which limits a lot of that growth. Its cash value growth is also extremely slow. It has a very long surrender period, much like variable annuities, and it provides really hefty commissions to the agents who sell them. Again, it's also going to be marketed as a tax free growth asset, but people can create a simpler and a lot more flexible way to manage their taxes while receiving income during retirement. A few reasons why whole life might make sense are when estate planning is involved. If you have a net worth more than $20 million, then a whole life policy might make sense. Or if you have a very old policy with very big surrender penalties, then it might make sense to keep that instead of unwinding it. But aside from these two examples, I really can't see why I would ever recommend it. Okay, number 7. Vacation homes. I've seen a lot of people buy a second home with the intent of using it as a vacation spot when they are in town and to rent it out when they're not in town. Lake homes, beach homes, and mountain homes, they're the most common. But here is why this strategy rarely works. A vacation home is not an investment. It's a lifestyle choice that is really expensive to maintain. People usually underestimate the property taxes, the maintenance and repairs, the furnishings, and they also underestimate the cost and time it takes to actually travel to that property. They also underestimate how big of a headache it is to find renters and how much of a pain in the butt it is to actually manage this property. So if you're retired, you got to ask yourself, do you really want to be managing a rental property, especially one that is not nearby you? Most retirees, they underestimate the total carrying cost, and they often overestimate how often they're really going to be using this property. Another issue that I've seen come up with vacation homes is how difficult it is to sell the property once someone decides to finally get rid of it. Usually these properties are in really small, remote locations, think ski resorts or small lake towns. And these places usually have one or two realtors in that area, and their fees are going to be really high. And the demand in places like this are going to be pretty low. So if you're hoping to sell this very quickly, you're going to be hard pressed to do so. Now, there are exceptions to this rule for vacation homes, of course. If you have a deep emotional tie to a specific location and is the key word here, it is cash flow positive without affecting your long-term financial plan, then of course it can make sense to keep it. But if this property is cash flow negative and owning this property is going to seriously impact your retirement plan, then you should choose to rent instead. So in the end, know that rich retirees, they're not rich during retirement because they found a magical investment. What they did instead was just to avoid bad investments. So these 7 assets aren't just poor choices. They're some of the most common traps that retirees fall into simply because they look safe, they look familiar, and they have words like guaranteed in them. So if you're planning for retirement and you want help avoiding these kinds of mistakes, please feel free to reach out to us at bullock.com. We're more than happy to see if we can help. So thanks for watching, and I'll see you next time.